Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the confusing world of corporate finance, probably with a little too much enthusiasm for numbers. Today we are dissecting a report that is actually 4 reports in one for the advisors in a circle fund, the third, which encompasses several Southern Sun funds. Think of it as a financial smorgasbord, and we're going to find the most interesting dishes for you. So what exactly is this form N-CSR? Well, it is essentially the certified shareholder report for registered management investment companies like mutual funds, which is exactly what we have here. It is where they lay out their performance, their investments, and all the nitty-gritty details for investors. Let's dive into the financial meat of this report. As of the 30th of September 2025, the Southern Sun Small Cap Fund and the Southern Sun US Equity Fund, as part of the Advisors Inner Circle Fund, the third, boast a combined total net assets of a whopping $276,710,002 for the Small Cap Fund and $43,408,004. $78 for the US Equity Fund. That is a lot of money being managed. Looking at performance across the board, the Southern Sun Small Cap Fund class, N-shares returned a rather uninspiring negative 0.89% for the year. Its benchmark, the Russell 2000 Index, however, returned a much healthier 10.76%. That is a clear underperformance, folks. For the Southern Sun US Equity Fund Class N shares, it saw a small gain of 0.67%, again falling short of its benchmark, the Russell 2500 Index, which zipped ahead with 10.16%. It appears that in the past year, market sentiment and macroeconomic factors like tariff announcements and Fed policy shifts played a bigger role than individual stock picking by the fund managers. Let's see how this played out over a longer term. The tables show a hypothetical investment of $10,000 in the Southern Sun Small Cap Fund. Back in September 2015, that $10,000 would have grown to $24,580 by September 2025. Not bad, but compare that to the Russell 3000 Index, which would have turned that same $10,000 into a staggering $39,447. The Russell 2000 Index also outperformed, significantly growing the initial investment to $25,391. This long-term trend highlights a consistent struggle for the small cap fund to keep pace with its benchmarks, especially when considering the Russell 3000's impressive growth. The story is similar for the Southern Sun US Equity Fund Class I shares. A hypothetical $100,000 investment made 10 years ago would have grown to $251,934 by September 2025. Again, impressive in isolation, but when you look at the Russell 3000 Index, that same investment would have ballooned to nearly $400,000. The Russell 2500 Index also significantly outperformed. It is clear that while these funds are generating positive returns, they are consistently lagging behind the broader market indices over the long haul. Digging into the fund's internal workings, we see some interesting statistics. For the small cap and US equity funds combined, they hold 23 and 24 individual companies respectively. The total advisory fees paid are quite substantial, with the small cap fund paying over $2 million and the US equity fund paying over $300,000. And the portfolio turnover rate is 30% for the small cap fund and 17% for the US equity fund. This means the fund managers are actively buying and selling stocks, which can incur transaction costs. What exactly are these funds investing in? When we look at the sector weightings for the small cap fund, industrials are the largest slice of the pie at 28.2%, followed by consumer discretionary at 21% and information technology at 18.3%. For the US equity fund, industrials dominate with a massive 49.8%. This heavy concentration in industrials suggests a strategy betting on a particular sector's growth, which can be a double-edged sword. Let's talk top holdings. For the small cap fund, Brinks takes the lead at 7.3% of total net assets, followed by US Physical Therapy at 5.5% and Live Oak Banches at 5.1%. These top holdings represent a significant portion of the fund's assets. This concentration can amplify the impact of any single stock's performance on the entire fund. Now let's talk about the folks auditing these funds. Fees billed by PricewaterhouseCoopers LLP for the year ending the 30th of September 2025 amounted to $228,709 for audit fees. And what about tax fees? Well, for the same period, there were no tax fees billed to the trust itself, but $25,000 were billed for services to affiliates in 2024. This points to a significant amount of trust placed in their auditors. In addition, Ernst & Young LLP also billed fees amounting to $144,346 for audit fees for the year ending the 30th of September 2025. They also billed $32,365 for tax fees related to UK reporting fund status. These audit and tax fees are crucial for ensuring the financial integrity and compliance of the funds. Moving on to the core financial statements, we see the breakdown of assets and liabilities. For the Southern Sun Small Cap Fund, total assets are about $277 million with liabilities around $410,000. For the US Equity Fund, total assets are around $43.5 million with liabilities just under $84,000. These numbers give us a snapshot of the fund's financial health at year end. The statements of operations show us how the money is made and spent. The Small Cap Fund had a net investment loss of over $573,000 for the year. The US Equity Fund also had a net investment loss of almost $96,000. These losses indicate that the income generated from investments didn't cover the expenses during this period. However, this is offset by realized and unrealized gains or losses. The schedule of investments is a deep dive into what the funds actually own. For the Small Cap Fund, the cost of its investments was over $217 million, while its current value is over $266 million. For the US Equity Fund, the cost was over $33 million, and the current value is over $42 million. This shows a healthy unrealized gain on the investments overall. Now, for the crucial notes to the financial statements, these notes explain the accounting policies and provide context. One key aspect is security valuation, where investments are categorized based on the reliability of their pricing inputs. For both funds, all investments as of the 30th of September 2025 were classified as Level 1 investments. This means they are valued using unadjusted quoted prices in active markets for identical unrestricted assets. This is the highest level of valuation confidence. Finally, we have the report of independent registered public accounting firm PricewaterhouseCoopers LLP states that in their opinion the financial statements present fairly in all material respects the financial position of each fund. They confirm they conducted their audits in accordance with the standards of the Public Company Accounting Oversight Board. This is the auditor's stamp of approval on the financial health and reporting accuracy of the funds. So what is the big picture here? These funds underperformed their benchmarks in the past year and even over a 10-year horizon. The story is similar with the market indices significantly outpacing the fund's returns. While the funds do hold a substantial amount in investments that have appreciated in value, the management and sector concentration strategies seem to be a drag on performance. The heavy emphasis on industrial sectors, a strategy that carries significant risk if that sector underperforms, presents a notable weakness. The fees paid to the investment advisors and auditors are also considerable, which naturally impacts overall returns. Overall, the advisors' Inner Circle Fund, the third Southern Sun funds, appear to be navigating challenging market conditions, where passive index investing has significantly outperformed active stock selection. Their commitment to investing in quality companies is commendable, but the long-term underperformance against benchmarks, especially for the small cap fund, is a concern. Investors might want to consider if the current strategy aligns with their long-term goals given the consistent lag in returns. Alright, that is our deep dive into these SEC filings. What are your thoughts on these fund performances and their investment strategies? Do you think active management is still worth it when benchmarks are consistently outperforming? Let us know your take in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate financial deep dives. And hey, if you want to connect with fellow finance enthusiasts and get even more exclusive content, join our Discord community linked in the description. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.